This Congress, the Senate Finance Committee, has investigated a number of tax schemes that very wealthy, with the help of armies of high-priced tax lawyers and accountants, are using to pay virtually no federal tax for years on end. Today, we're going to examine one strategy called buy, borrow, and die. You can see those three words in back of the dais. Those three words on the chart behind me have an enormous impact from the standpoint of taxes. Here's how it works. A corporate raider buys a business. Then they borrow against its growing, untaxed value to fund an extravagant lifestyle. Everything from super yachts to luxurious vacations, expensive art deals, you name it. It just goes up and up in value while not paying a dime in taxes. And when they die, the assets are passed to the kids, often entirely tax-free, and this cycle I've described just continues. Now let's contrast buy, borrow, die against the tax system mandated for everybody else in America. If you're a nurse or a firefighter living in Philomath, Oregon, you're required to pay taxes out of every paycheck. Working people don't get to play by the same rules as billionaires. They don't get to call up an accountant every time they don't feel like paying taxes. Right now, the average billionaire can wriggle their way to paying 8% as a tax rate, while the nurse or a firefighter making $45,000 is paying a 22% tax on their wages. How is that fair? Americans overwhelmingly believe it's not fair. So it's time to look to solutions that restore fairness to the tax code while still rewarding success. Success is what America's all about, and we want to reward it. That's what our country's founded on. That's the idea that everybody, let me emphasize that, everybody's got a chance to get ahead. Fortunately, there's a solution that achieves both fairness and economic growth. It's called mark-to-market, and here's the kicker. There's already a version of mark-to-market in the federal tax code. So what that means, colleagues, is we've got a blueprint right in front of us to use as a model for mark-to-market provisions that would apply to billionaires. Put simply, mark-to-market would require billionaires to pay tax every year, just like everybody else. Buy, borrow, die is the primary mechanism billionaires use to avoid taxes. If left unchecked, you're inviting more gaming into the system. Ending buy, borrow, die is the best way to ensure that billionaires pay their fair share. Tax laws just don't apply to billionaires in the same way they do to everybody else. They're optional for billionaires, where everybody else's tax rules are mandatory. It's time to close these loopholes and make sure that those at the very top are paying taxes on their income as it's earned, like everybody else. Now, I'll close with this. Our finance team and I have been fighting tax injustices throughout this session. We investigated crooked Swiss bankers who are hiding wealthy Americans' income. $34 billion in unpaid taxes from millionaires who just don't feel like even filing a tax return. Tax dodging schemes between Leon Black and Jeffrey Epstein. And Supreme Court Justice Clarence Thomas's wealthy buddy secretly forgiving a massive private loan. Americans deserve a tax system that's both fair and encourages success. My hope is that this could be bipartisan. The invention of Roth IRAs, for example, was bipartisan. A Republican idea. Chairman William Roth helped working Americans save for the future and get ahead. And Chairman Roth, when you read the documents, always talked about being there for the people of modest means. And my friend Senator Carper, of course, remembers Chairman Roth, but that's what the Roth IRA was about. It was for people of modest means. Now, the ultra-wealthy are abusing these to shield their vast fortunes from federal tax. It's time to end this exploitation of current tax laws and use the funds, that portion that is way, way, way up at the top for a handful, use that money to help families. For example, it could be used to get a jump start on child savings accounts, something that our colleague, Senator Bob Casey, has been working on for years. So I've laid out just a few of the endless ways the super wealthy avoid paying their fair share, and I'll close with a gut punch. Everything I have described is legal. Everything. Perfectly legal. And I just know when I go home and I have a town meeting, I've had 1,060 of them, and I say that, people are just boiling. All that stuff is legal, Ron? Yep, all legal. And that's why people feel the deck is stacked against the working families. Wealth continues to build up in the hands of the fortunate few, and so many are left behind. Over 1/3 of American families do not have the cash on hand to pay for a $400 emergency. Meanwhile, during the pandemic, when families were forced to make tough choices between paying rent and buying groceries, billionaires increased their wealth by over $1 trillion. So, time to set aside business as usual. There's growing support, in my view, and demand for solutions that restore fairness to the tax code, level the playing field for working families, and promote success. I want to close by saying you can only have a successful economy if you have a tax code that treats everybody fairly. Just that simple. It's past time to close the gap between those at the top and everybody else. I look forward to working with my colleagues on the committee. It's been a busy week for the Finance Committee. Senator Crapo deserves enormous credit for yesterday, and we got a 26-0 vote on a really landmark health care bill to rein in these middlemen. And you'll probably hear we have some differing opinions here today, but I just want people to understand that I so appreciate Senator Crapo's willingness to debate these issues and find common ground where we can, which is quite often, as people saw yesterday. Senator Crapo.
Well, thank you very much, Mr. Chairman, and I agree with you. You and I have a track record, I think, of finding the doable where we can build consensus on a bipartisan basis. There will be a few areas where we disagree today, but I look forward to our discussion today on the effect of the tax code on individuals and families as they work, save, and invest. The scope of today's hearing provides members the opportunity to cover a broad range of topics, and we will no doubt hear a number of concerns raised about how the code treats high-income taxpayers. We should dispel the notion that there is any support for taxpayers who evade their tax obligations. We all agree that taxpayers should pay the tax they legally owe. Senator Wyden indicated what he's talking about is legally undertaken activities. And for the gray areas of taxpayers who aggressively structure their affairs to reduce their tax liability, we should constantly assess how the code can better and more fairly target activities. But framing this issue through the subjective lens of fairness often ignores the facts and turns a blind eye to favored initiatives or incentives. Rather than focusing on rhetoric, we should examine the data and how the code affects behavior. That includes examining provisions that primarily benefit a select group of the financially well-off, including tax credits for those who can afford expensive electric vehicles, costly energy home efficiency upgrades, and proposals to repeal the cap or expand the highly regressive deduction for state and local taxes. All of these primarily benefit the wealthy. As for the data, these are the indisputable facts. Most of the federal tax burden is paid by high earners. Federal tax collections have been near all-time highs. The voluntary tax compliance rate is high and stable, and higher income taxes serve as disincentives to work, save, and invest. My Republican colleagues and I remain focused on safeguarding taxpayers and their rights, reducing barriers to work, savings, and investment, and promoting opportunity and wealth to improve the quality of life for all Americans. In 2017, the Republicans lowered individual tax rates across the board, with middle-income taxpayers getting the largest proportional benefit. Republicans also simplified filing for many, expanded the child tax credit, and limited regressive tax spending like the SALT deduction. Critics charged that letting Americans keep more of their earnings would stifle the economy, dry up federal revenue, and favor the wealthy. Instead, it created one of the strongest economies in our nation's history, including an unemployment rate that reached a generational low, increased federal tax collections to near all-time highs, grew wages across the income spectrum, and expanded job participation. All Americans benefited. Notwithstanding claims that high earners pay the least taxes, the reverse is actually true. According to the Biden Treasury Department, in 2023, the top 1% of all earners paid 42% of all federal income taxes, the highest despite only earning 19% of all of the income. In 2001, the top 1% of earners contributed 33.2% of income tax revenue, 9 points lower. In other words, the country's income tax burden is more progressive today than it was decades ago. Expanding the aperture to examine the top 5% of taxpayers, those with incomes above $200,000 a year, mirrors this same dynamic. Those Americans pay 65.3% of all federal income taxes, while making only 34% of all income. Meanwhile, federal tax collections have reached an all-time high of $4.9 trillion in fiscal year 2022, with individual income tax collections contributing the most, growing by 29% year over year. In fact, individual income tax collections reached 10.5% of GDP in fiscal year 2022, the highest level on record. All of this is after the impact of the Republican-led tax reform. In arguing for tax code fairness, some have pointed to a recent tax gap projection from the IRS, which shows an increase over the previous estimate. This growth actually shows one of the many effects of inflation. Despite headlines to the contrary, the tax gap is proportionately flat and historically average relative to the economy's size. According to the Cato Institute's examination of the tax gap as a percentage of GDP, for 2021, that ratio was 2.9%, squarely in line with the 20-year average. And the voluntary tax compliance rate, around 85%, remains substantially unchanged. While we should work to find bipartisan measures to narrow that tax gap, any such effort must not reduce economic growth. I look forward to hearing the perspectives of today's witnesses on how the individual tax system affects taxpayers from all income groups and how increased taxes in the midst of high and sustained inflation would impact our economy. Thank you, Mr. Chairman.
Thank you, Senator Crapo, and I share your views. We're going to have a good debate, and I think the four witnesses that we have are going to reflect it. Let me introduce everybody. If I missed something about your background, we'll make sure we get it in the full record. Chai-Ching Wang is Executive Director of the Tax Law Center at NYU. I think you all are around the corner from the Strand Bookstore, I think. I know somebody there.
You do.
Before starting the Tax Law Center, she was Senior Director of Economic Policy for the Center on Budget and Policy Priorities. We've worked with her often and appreciate her expertise. Second witness will be Morris Pearl, Chair of the Patriotic Millionaires, group of high net worth Americans who support fair taxation of wealthy individuals and large corporations. He was a managing director at BlackRock, so we're going to get a very important perspective from a major investment firm leader. Our third witness will be William McBride. We've worked with him often, Vice President of Federal Tax Policy at the Tax Foundation. Previously, he was a manager in the National Economic and Statistics Group at Price Waterhouse. We welcome Mr. McBride. And the fourth witness we've had to this committee, Douglas Holtz-Aiken. I have known Mr. Holtz-Aiken for years and years, going back to our days with the CBO, and I very much appreciate having a chance to get his input, and we're glad that he could be with us. So all our witnesses bring considerable experience in tax policy to the table. Your full statements are going to be entered into the record. We'll ask that you keep your remarks to no longer than 5 minutes. And Ms. Wong, why don't we start with you? And I think you're going to give us kind of the nuts and bolts, sort of the operation of how this thing goes on, because that's what people really want to know.
Thank you, Chairman Wyden. Ranking Member Crapo, distinguished members of the committee, I'm really honoured to join you today. The highest income filers receive tax breaks on income from wealth to the tune of hundreds of billions of dollars each year. Largely unknown to most Americans, these tax breaks increase deficits and deepen inequality. The outright tax breaks inevitably spur tax avoidance and evasion. That harms the economy by locking up capital in old investments where the tax breaks are the most lucrative, instead of it flowing to new and productive ventures. Talent goes to waste, dreaming up new tax shelters for the ultra-wealthy, instead of driving business and scientific innovation. Those who want to focus on work and entrepreneurship face competition from tax avoiders and evaders. Here's how the system works. Tax breaks on wealth allow the highest income filers to choose when to pay income tax, at what rate, and even whether to pay it at all. Most Americans make the bulk of their income from work, but the highest income filers make the bulk of their income from their wealth. That's stocks and bonds, real estate, personal property like art, and ownership in pass-through non-corporate businesses. These assets throw off income, including dividends and the capital gains from when they increase in value. But while the top rate on salaries is 40.8%, the top rate on long-term capital gains and dividends is dramatically lower at 23.8%. And while most Americans pay taxes on salaries in the year that they earn the income, and often withheld in every paycheck, most capital gains are invisible to the tax system until they're realised. That's when the asset that is increased in value is usually sold. So the wealthiest filers can choose when capital gains show up on tax returns, and meanwhile, they see that income in their bank statements and they can borrow and spend against it. If they hold the assets that have gained in value until they die, then neither they nor their heirs will ever pay income tax on that gain. And that's how billions of dollars in income gets an income tax rate of 0. These are large outright tax subsidies for wealth. JCT estimates that the 0 and low rates on capital gains and dividends cost the federal government more than $200 billion last year. And that's more than the CHIPS and Science Act's entire investments in innovation over a whole decade. It's also just the start of how wealthy filers can benefit from low rates on income from wealth. Their tax planning techniques can be complex, but they have a simple aim. Just shift as much income from assets and work into the lowest possible tax rates on wealth. Carried interest is used by fund managers to get a low capital gains rates on income from their services. Pass-through businesses can help the wealthy to avoid income and payroll taxes. And there's an alphabet soup of other vehicles that are getting co-opted to shelter capital income from tax. Things like private placement life insurance, the ETF loophole, HSAs, mega Roths, many more. These wealthiest filers have well-paid lawyers and accountants to set up spider webs of entities and transactions. And then sometimes this egregious but lawful tax planning goes from those grey areas and right on into tax evasion. The complex and opaque tax system for the wealthy can also give cover to money launderers, sanctions evaders, and corrupt officials looking to hide assets and income. All income underreporting by the top 1% was $80 billion per year added to the tax gap of taxes owed but not paid, and that's more than the annual budget of the Small Business Administration. Lawmakers can move federal and private resources away from tax breaks on wealth and instead make better investments in the nation's future. Various tax cuts for wealthy filers should expire as scheduled in 2025. That includes the pass-through deduction and the doubled estate tax exemption. The IRS should have the resources and tools it needs to continue to ensure that wealthy filers pay more of the taxes that they owe. And various tax breaks on income from wealth can be repealed or scaled back so that the wealthy pay effective rates that are closer to the rates on salaries. Members of this committee have responded over many years on a bipartisan basis to all the tax shelters that pop up to try to seek the benefit of those breaks, but they'll continue to pop up unless the underlying problem is addressed. My testimony lays out a menu of options, and I would be happy to take your questions.
Very good, Ms. Wong. Thank you, and taking us through the nuts and bolts is what we're going to have to do, because I know when I bring this up at town hall meetings, people still, after you take it through once or twice, people say, they can actually do that? It's legal? And then you have to say, yeah, it's legal. And so we got some work to do to fix this, and we appreciate your leadership. Mr. Pearl, welcome.
Yeah, thank you, Senator Chairman Wyden and Ranking Member Crapo, and all of the senators for giving me the honor of appearing before you today. I've had a long career on Wall Street. I currently serve as the chair of the Patriotic Millionaires. But most importantly, for the purpose of this hearing, I'm exactly the kind of person that our tax code is designed to advantage. And the cost of these advantages are a permanent upper hand for the wealthy over people who work for a living, the economic instability of an extreme concentration of wealth and income at the very top, an eroding consumer base and tax base, and social instability as more and more people realize that putting in a hard day's work is no longer a path to dignity and a financially stable life. The original sin of our tax code is the way we value money and wealth above work and wages. Your constituents who work for a living have tax deducted from their paycheck every single week. I earn money just by watching my numbers on my brokerage statement go up. I can decide to have that income become taxable if and when I feel like it. We do not tax capital gains until the time of sale, which means for people like me, taxes are essentially optional. We can take out loans to fund living expenses and never realize capital gains and never pay taxes on them. And when we die, thanks to the step up in basis, we're able to pass that wealth on to the next generation completely free of income tax. And the whole buy, borrow, die process starts again. The problem is people who are rich don't need taxable income. They're already rich. We suggest the money made by investors should be subject to taxes just like the money made by your constituents who work for a living. And that's the essence of the proposal from Chairman Wyden and the proposal from President Biden. My own family benefited from the step-up basis rule, inheriting shares of stock that had a gain of over 62,000%. 62,000%. And we enjoyed millions of dollars of gains on which no one has ever paid any income tax and on which no one ever will pay any income tax. And we didn't need any army of lawyers or accountants. We simply follow the rules as they are written in the current tax code. Even when I do choose to realize gains and pay taxes, the rate I pay is far below the rate of people who earn that much from their work. This is supposed to incentivize investment, but that fundamentally misunderstands what drives investors. My options are to invest my money and get some growth, or to stuff my money under my mattress or something. And mattresses do not have very high returns. Perhaps even more ridiculously, we give the same benefit to fund managers who are managing other people's investments through the carried interest loophole. If we believe that we should be using the tax code to incentivize people to enter certain professions, I would put emergency room nurses above fund managers. Even the wealthy people who earn most of their income from work don't experience a truly progressive tax code. Our top bracket for a married couple starts at a little below $700,000. A lot of money, But we're not even talking about people in that tax bracket. We're talking about people who are in 70 million or 70 million or 700 million. That couple earning 700,000, they pay Social Security tax on a substantial portion of their income, but the burden of that tax on a couple making 70 million is negligible, well under 1% of their income. Many people, including some of you on this committee, have offered serious solutions that would help reorient the way we tax the ultra-wealthy. Your proposals to tax extreme wealth, including Senator Warren's ultra-millionaire tax and the Oligarch Act proposed by Senator Barbara Lee and others in the House. We also need to tax unrealized capital gains, as Chairman Wyden's proposal or President Biden's proposal. To be clear, I am not against being rich. I lead an organization of millionaires. We know being rich is great. We recommend that everyone try it. But investors and business people do not want a nation with a few rich people and lots of people just struggling to get by. That is not where we can invest and build businesses. Money does not trickle down. Money trickles up from every mortgage payment and every phone bill payment you make to investors like me who invest in mortgages and phone companies. We need a nation filled with people who have enough money to spend on things. That is what makes the economy work for everyone, including investors. The tax code can and should be used to reduce and constrain inequality, as the status quo is doing the exact opposite. Thank you. Happy to answer any questions.
Thank you, Mr. Pearl. And just so we're clear, you were managing director at the major firm BlackRock, is that right?
Yes, I was one of hundreds of managing directors there. Mostly I worked for the federal government, figuring out how much the bailout was costing the taxpayers when Citibank was bailed out.
Good. Dr. McBride.
Thank you, Chairman Wyden, Ranking Member Crapo, and members of the committee. I appreciate the opportunity to speak with you. My testimony will focus on the size and distribution of the federal tax burden. Over the last 2 years, we have seen an extraordinary rise and fall of federal tax collections. In fiscal year 2022, the federal government collected an all-time high of $4.9 trillion in taxes, nearly 20% of GDP, the highest level as a share of GDP in 22 years, and prior to that, World War II. In fiscal year 2023, federal tax collections dropped to $4.4 trillion, or about 16.5% of GDP. In a typical year, more than half of federal tax revenue comes from individual income taxes, which reached an all-time high of 10.4% of GDP in FY 2022, before falling to 8.1% of GDP in FY 2023. The volatility reflects broader fluctuations in the economy and financial markets, combined with the fact that a large share of federal tax revenue comes from taxing capital gains, profits, and other volatile income sources mainly reported by high-income individuals. The federal tax burden over the last 2 years has on average been relatively high, with individual income tax collections as well as total collections well above their long-run averages since World War II, measured as a share of the economy. Most of the federal income tax burden is paid by high earners, as is the majority of the entire federal tax burden. According to the latest IRS data, of all federal individual income taxes collected, the top 1% of individual taxpayers paid a 42.3% share, a larger share than the bottom 95% of individual taxpayers combined. The top 1% share of taxes is the highest in at least 20 years. High-income taxpayers also pay the highest tax rates, according to the IRS. The average individual income tax rate in 2020 was 13.6%. The top 1% of taxpayers paid a 26% average rate, more than 8 times higher than the average rate paid by the bottom half of taxpayers. When accounting for all federal taxes, including taxes on corporate income, payroll, estates, and other sources, the federal tax code remains very progressive. According to the latest data from the CBO, the top 1% of households paid about 25% of all federal taxes in 2019 and had an average federal tax rate of 30%. In contrast, the bottom 20% of households paid about 0.1% of all federal taxes and paid an average federal tax rate of 0.5%. There's nothing simple about the way in which the federal government collects these taxes, especially individual and business income taxes, which in many ways are inherently complex, and various credits and preferences add to the complexity. The tax code currently totals about 4 million words, such that no taxpayer can reasonably be expected to fully comprehend it. In 2022, Americans spent more than 6.5 billion hours trying to comply with the tax code, equating to about $313 billion a year in lost productivity. This does not include the cost of tax planning or of uncertainty in the law, which makes planning for taxes as well as investment in other economic activities difficult and costly. The increasing complexity of the tax code has contributed to an overwhelming administrative challenge for the IRS. Last year, for instance, the IRS answered only about 13% of the 173 million phone calls it received from taxpayers asking for help. Call volume declined this tax season, and the IRS answered a higher percentage of calls, but other metrics worsened, including longer processing delays and an increased backlog of identity theft cases. There are also the substantial and well-documented economic cost of high marginal income tax rates, arising from disincentives to work, save, and invest. For instance, researchers at the OECD concluded that corporate income taxes are the most economically damaging way to raise revenue, followed by individual income taxes, consumption taxes, and property taxes. One of the most problematic and economically destructive aspects of the U.S. tax code is the double taxation of corporate income. First by the corporate income tax, now also the book minimum tax, and then by shareholder taxes on capital gains and dividends, yielding a combined top tax rate that approaches 50% after accounting for federal and state taxes. In short, we as a country have built a federal tax system that is inherently complex, costly, and controversial. To the extent it is comprehensible at all, taxpayers do not perceive it as fair. The IRS has real challenges administering such a complicated tax system, but boosting the IRS budget will not fix the underlying problem that causes millions of taxpayer calls to the IRS every year seeking help. As top priority, lawmakers should simplify the tax code so that taxpayers can understand the laws and the IRS can administer them with minimum cost and frustration. Second, lawmakers should reduce the economic drag caused by the tax code, particularly in the current environment of high interest rates and still too high inflation. My written testimony outlines certain revenue-neutral reforms that would greatly simplify the tax code and improve economic growth. I'm happy to discuss those further in follow-up questions. Thank you for your time and attention.
Thank you very much, Mr. McBride. I can tell you, you'll have me at hello if we can get rid of buy, borrow, and die and add some simplification to the tax system. That's a winner. Okay, Doug Holtz-Aiken, welcome. You've been here often. Glad to have you.
Well, thank you, Mr. Chairman, Ranking Member Crapo, and members of the committee. It's a privilege to be here to discuss these issues. Let me begin by just putting them in context. The U.S. has two major policy problems, in my view. One is subpar economic growth over the long term. Trend growth is about a percentage point lower than it was in the 20th century. And the second is our fiscal house is fundamentally unsustainable looking forward. Now, accepting the slower rate of growth in the 21st century has cost the average person in the United States $19,000 in real income. GDP per capita is $19,000 lower than it need be, and it means a sacrifice of about $12 trillion in federal revenues. So improving economic growth can also be a route to improving our fiscal outlook. The fiscal outlook is dreadful. CBO's baseline includes $20 trillion of deficits over the next 10 years. Debt to GDP is going to rise from about 100 to 120%. And the structure of the federal budget, these large deficits, is a headwind to growth and threatens to further reduce the pace at which we grow. Now, how should we address this? The bulk of the increase in deficits, as I outlined in my written testimony, is going to occur on the spending side, in particular the large mandatory spending programs in your jurisdictions, Social Security and Medicare. They more than explain the rise in deficits over the next 10 years. And they, as a result, are the most important reforms that you can undertake. Beneficiaries deserve to have a financially sustainable social safety net. The red ink is a danger to the economy, and to reduce this would, in fact, improve economic growth. How does tax policy fit in this context? Well, it is imperative that we have faster and sustained economic growth, and tax policy should be in a very disciplined way, focused on being pro-growth. That means where revenue needs to be raised in the least economically damaging way possible. Consumption taxes, as Mr. McBride mentioned, are top of the list. broadening the tax base to cover currently exempt consumption would serve to do that. And we should keep taxes on the return to saving, investment, and innovation as low and uniform as possible. That's the recipe for supporting more rapid economic growth. It also turns out to be the recipe for getting rid of the tax avoidance that is troubling to Americans and the subject of this hearing. The recipe for putting together a tax shelter is to take advantage of the differential tax rates on corporate and non-corporate returns to capital income distributed as interest, dividends, and capital gains. These are all legal, and they are the result of a tax code that is too complicated and sets up incentives for avoidance and makes it easy to do. The thing to do for economic growth is to reduce those taxes and make them more uniform. The thing to do to get rid of avoidance schemes is to reduce those tax rates and make them more uniform. So this hearing is right in line with what is necessary to support the problems that the United States faces going forward. Finally, and I'll just close, the avoidance is a very real product of the tax code as it's designed. The evasion is unforgivable. And so I think we need to simply have an IRS that is equipped, staffed, and has a mission focus that is to enforce the tax code in a fair fashion across the income distribution and not focus merely on high-income individuals. Any examination of the tax gap shows that this occurs in both small businesses, large businesses, affluent, less affluent Americans who need an IRS that is looking for those dollars in wherever they may be. So I thank you for the chance to be here today. Look forward to your questions.
Thank you, Dr. Holtz-Aiken. And all of you are going to get some questions. I'm going to try to take this whole tax debate, which sometimes sounds like prolonged root canal work, and put it into kind of English. The little sign in back of us here is what is especially troubling. You can buy, you can borrow, you die, and billionaires can avoid taxes. Now, I want to ask Ms. Wong a little bit about how this actually goes down, and I want you to sort of flesh out the example that I'm giving. A corporate raider buys a business. Then the raider borrows against its growing untaxed value, and they're doing that to fund an extravagant lifestyle. That means they can get super yachts, luxurious vacations, expensive art deals, you name it. And it just keeps going up and up in value while not paying a dime in taxes. And Ms. Wong has been educating me on this, and when this person dies, their assets get passed to their kids, often entirely tax-free, and what a surprise. The cycle just goes around and around and around. So, Ms. Wong, you are an expert in the field and you teach it. Tell us a little bit more about how this takes place, because as far as I can tell, somebody who wants to do this, Mr. or Ms. Big, calls up their accountant and their tax lawyers and says, get over here. And they, what do you want to talk about? I want to make sure I don't have any taxable income this year. That's my goal. I want to make sure I don't have any taxable income this year. So they set out to be able to do something very different than the firefighter and teacher. They don't want taxable income. And the accountant and the lawyers come over, and what do? I mean, how does it all go down?
I mean, you've got it almost exactly right to start with. A couple of questions that people often ask is like, well, aren't they paying interest rates on this? Doesn't this cost them something? And usually the answer is they get very low rates because they have a lot of wealth and a lot of collateral and a very low risk.
They get low interest rates from the bank.
Exactly.
Okay.
And then another question people ask is, well, how do they pay back those loans? And quite often they don't. They just roll them over again and again. And if they do, they might do it with some of their other sources of income that are taxed, such as dividends. Very, very wealthy people tend to have multiple sources of income. And as you said, I mean, you could be working as a tax advisor. You laid it out so clearly, but as an advisor who works on these loans said, you can buy a boat, you can go to Disney World, you can buy a company. This is real income, and you can use it for real things, and you get stunning tax benefits because it escapes the income tax entirely.
And I gather there are tax lawyers and accountants who are experts at buy, borrow, die. I mean, they're people who, when they get called by a client who doesn't want to pay federal income taxes, doesn't want to do what firefighters and nurses do, there's a pretty good squad of them who are ready to go.
Exactly. And, again, this is, you can do the basics of this pretty simply, but if you want to shove some of your labor income or your income from other types of assets into this scenario, and to also avoid the estate tax that is supposed to be a backstop on this system, that's where some of the more complex schemes come in.
Okay. Question for you, Mr. Pearl. You come from the private sector, from a very large firm, and you've basically said, this idea that if you do something about fixing buy, borrow, die, and if you do, some critics will say, Western civilization is practically going to end. We will lose investment, and there will be a parade of horribles that will be visited upon our nation, which of course we don't want. We want people to be successful. We want everybody to be successful. I think what you have tried to do is put on the record that there's no way that's going to happen. Well-to-do people that you have worked with are not going to this weekend rush out and put everything under their mattresses to defend themselves from the United States Senate. They're still going to have plenty of opportunities to do well, to be successful, to invest. Is that essentially your argument?
Yes, Senator Chairman Wyden. We wealthy people invest money, and I would certainly rather invest my money at a high return and keep half and pay the other half in taxes than get no return at all. Paying high taxes is great because it means you have high income. I think one of our issues is that many people think high income, a United States senator has high income. No, we're talking about people not who earn a few $100,000 or a few $1 million a year. The people that would be affected by your proposals are for mark-to-market are people who earn hundreds of millions or billions of dollars in economic income, but almost nothing in taxable income. I think that's part of the issue is we have to redefine what we mean by taxable income as money you make regardless of how you make it, whether it's from a paycheck or from just watching your stock market investments go up. You're making money, and you should pay taxes on that money the same as everyone else does.
I'm well over my time. Senator Crapo.
Thank you very much. It seems to me that as I've listened to the testimony today, probably the major focus is on the differential in tax rates between capital gains and other taxable income. So I'm thinking about this. It seems to me that the impression is that only rich people have capital gains. But we all know that anybody who's been investing in a retirement plan for their future, anybody who owns a home, anybody who owns a capital asset has a capital gain. And so it seems to me that if the solution were to just make the tax rate the same for capital gains and ordinary income, that we would be putting a tax increase on a tremendous number of people who are not in the category of your millionaires club, Mr. Pearl. And I don't think that that's what anybody on this panel is suggesting either. So my question, and I guess I'll go to you, Dr. Holtz-Eakin. What is the solution? Have I identified the issue that's being raised here accurately? And what is the solution if differential tax rates are causing these kinds of problems?
Well, the solution is to have tax rates equalized at as low a rate as possible so that you don't build the ingredients of these tax avoidance schemes. I mean, this tax avoidance scheme hinges on interest deductibility and a lower tax rate on capital gains than other sources of capital income. So
if we were to make the tax rate on capital the same as the tax rate on ordinary income, we could then lower the tax rates.
Yeah.
And people would not actually see overall a tax increase. Is that what you're saying?
I think the key is to, this hearing is focused on individual income taxes, but if you look at the scheme that the chairman described, it's the system. It's a corporate rater, and it's the tax treatment of both the entities and the individuals. The system has to collect taxes on capital and labor income, and that's not what we do very well.
Now, what about the notion that you don't pay capital gains taxes until you realize the gain? Do we have to make everybody realize the gain in their house every year? Do we have to make everybody realize the gain in their investments in their
No.
retirement fund every year?
I'm actually not a big fan of those strategies. There are approaches which focus on collecting such taxes at the entity level. These things are like the X-tax, personal progressive consumption taxes, all have a system where essentially the tax on capital income is collected at the entity level. It never gets out into financial markets. You don't chase it around the globe and do all the expensive things that are being proposed here. You simply collect it efficiently at the entity level, and it's collected on behalf of the individuals at that point.
All right. Dr. McBride, could you comment on this general set of questions?
Sure, I fully agree with these comments from Doug over here. It can be done to, and it should be done as a general principle to pursue uniform taxation, and even you can go so far as to equate the tax rate on ordinary income and capital gains. And we have a plan that does that, or we have a plan that we have modeled. It's not a hypothetical plan. It's actually a real tax system that exists out in the real world in a small country called Estonia. They have a 20% tax rate that applies uniformly to all sources of income, including capital gains, wages, et cetera. And it's a very simple system. It has a lot going for it. We have showed that if we implement it in the U.S., it would produce a lot of growth, a lot of jobs, a lot of increase in wages, et cetera.
So what does that plan do with regard to when gain is realized?
Well, no country has really experimented with that, as far as I know. Not on a broad scale that is being contemplated here. We do. It's true. We do in a few limited cases in the current U.S. tax code apply the tax to unrealized capital gains for some certain financial derivatives, et cetera. But there's no country or jurisdiction that I'm aware of in history that has tried to apply this approach broadly to, a majority of assets held by any income class.
All right, thank you. Just one other real quick question. I'm kind of shifting gears here rapidly, but an issue that comes up here often is, well, why don't we just tax corporations and not people? And so then, we've got this endless source of revenue. Who pays corporate taxes? Could you answer that, either of you, Dr. Holtze?
Individuals pay the corporate tax. It's either the shareholders or their customers in higher prices or the workers in lower wages.
Yeah, my understanding is that a pretty significant portion of it is paid by labor, and a pretty significant portion of it is paid by those who are in retirement plans, and a very small portion is paid by actual individuals who own the corporation, other than through their tax.
That's a fair summary, yes.
All right, my time's up. Sorry.
I thank my colleague, and I look forward to working with you, Senator Crapo, to explore these issues. Senator Menendez.
Thank you, Mr. Chairman. Over the last decade, the IRS budget shrunk by 20%, resulting in 20% of its workforce being laid off. And because of the IRS's lack of resources, audit rates for those incomes over $5 million dropped from 16% to just 2% over the same time period. And while middle-class families and small businesses have bared the brunt of the IRS customer service problems, wealthy individuals and large corporations have been all too happy to take advantage of the IRS's limitations and underpay taxes that they legally owe. That's why the historic $80 billion investment we made in the Inflation Reduction Act has significantly improved customer service and ramped up the enforcement on the highest earners. But we have our colleagues on the other side of the Capitol, on the Republican side, continuing to propose cuts to this critical funding. Ms. Huang, does cutting the IRS's budget for enforcement increase or decrease the federal government's revenue?
It decreases the federal government's revenue and overall adds to deficits.
So it decreases the government's revenue.
Decreases the government's revenue,
Yeah.
adds to deficits on net.
And who pays the price of tax evasion by the wealthiest and large corporations?
Well, the addition to deficits means either underinvestment in pressing issues in the nation, including raising workers' living standards, meeting global challenges, investing in innovation. It also could mean tax increases on other folks further on down the track to deal with those issues. And it also means that honest filers have to compete with tax avoiders and evaders when they are just trying to focus on their business and real-world work.
And obviously, the corollary of that affects negatively our national debt and annual budget abilities.
Exactly.
Now, I don't understand how some of our colleagues continue to push for a policy that makes it easier for tax sheets, while at the same time cut resources that are projected to reduce deficit spending, which is what I want to talk about next. Just 8 days left for the government's funding before we no longer have the funds necessary to continue to operate the services that the federal government provides for its people. Some of our colleagues are threatening a shutdown in order to extract spending cuts in the name of fiscal responsibility. It seems hypocritical to me to threaten a shutdown and call for spending cuts on the backs of working families when they've depleted the revenue side of the ledger over the last 5 years. Ms. Wong, how much did the 2017 Republican tax law add to the federal deficit over 10 years?
When it was enacted, about $1.9 trillion over 10 years.
$1.9 trillion. Did the bill pay for itself, as some of my Republican colleagues claimed?
Not at all. That estimate included any very small positive impact on the economy that's been very hard to see in the reality.
So we have $1.9 trillion that's lost on the revenue side, and this is very basic. If you had a business and revenue is not being produced, you have one of two choices. You either cut spending or you find another revenue source to increase it. Here we have revenue being cut dramatically, and then at the same time saying, well, we should have spending cuts for fiscal responsibility, but the revenue side of the equation never seems to be part of the fiscal responsibility. That's why, when I supported the Inflation Reduction Act, it actually cuts deficit spending while supercharging investments in some things that make our economy even greater. Finally, it's important, I think, to understand why we ask large corporations and wealthy taxpayers to pay for their fair share of taxes. It isn't to punish success or tax just for the sake of taxing. It's because we have real issues in front of us today, many of which impact our economic growth and our competitiveness on the global stage. For instance, we're currently in the midst of a child care crisis. Families across the country are forced to make impossible decisions, such as whether to leave the workforce altogether or to leave their children in unsafe situations while they go to work. Child care centers are being forced to close and pay invaluable teachers less than the minimum wage. So, Mr. Pearl, from your perspective as an asset manager, isn't using some of this potential revenue source towards making child care affordable a worthwhile investment that increases economic activity and business productivity?
Well, yes, business in our country depends on consumers who are able to pay for things, depends on parents who are able to work and work at their jobs. Even in New York, as we've increased child care availability for their young children, that has increased greatly the number of mothers who are able to work and earn money, and actually increased our tax revenues in the city where I live.
Thank you, Mr. Chairman.
So many members. Senator Blackburn, you were next.
Thank you, Mr. Chairman, and thank you all for being here. Dr. Holtz-Aiken, I want to come to you. There is this term that came up in one of our hearings, and the chairman's heard me talk about this several times. And it was a new term that Commissioner Werfel used. It was total positive income. And this came up in relation to that $400,000 threshold, where the administration claims they're not going to audit people that are making under $400,000 a year. Well, we also had Marjorie Rawlinson in front of the committee in September, and she seemed to have a little bit of trouble giving us a clear definition of what is total positive income. And I had done a little digging through Tennessee. I think you know my state fairly well. National Federation of Independent Business has just hundreds, thousands of members, small business owners. We are a very entrepreneurial state. And as I have looked and talked with businesses and reviewed this issue, it doesn't matter if it is a quilt shop or a tavern in East Tennessee, or if it is an independent electrician over in West Tennessee trying to do some work with Blue Oval City. What people keep saying is, what is total positive income, and who is going to be affected by these new audits that are coming on that? Because a lot of LLCs, LPs, sub-S, they're all on that individual return. And I would love to hear from you. If you can give me a definition, a working definition of what that is supposed to be, and what is that benchmark, and small businesses, what should their concern be about this?
I can't give you a working definition or any other definition. It's a concept that they have developed and they're using. I will say this: I cannot support this notion that the president's pledge to not raise taxes for people under $400,000 is the same thing as saying you're allowed to cheat on your taxes. That's just not okay. It doesn't matter what your income is. And those audits ought to be applied on the basis of evasion, the probability of evasion, and the ability to collect taxes that are legally owed. And no other criteria should matter. It makes no sense. Total positive income, total negative income, hyperbolic income, I don't care what the income measure is, apply it across the board and collect the taxes.
Is there anybody on the panel that can give a definition of total positive income as it relates to this $400,000 threshold?
I would agree with Dr. Holtz-Eakin is that one of the things that you need to be very careful of is not setting a threshold that then allows the worst tax evaders to just file their returns pretending that they have income below that level and therefore avoid detection and audit. And that's one of the tricky things about having a bright line. And I also agree with Dr. Holtz-Eakin that...
And no one knows where the bright line really is. Yeah. Well, that has been perplexing for a lot of Tennessee businesses, thousands of them. They can't figure out what is going to be coming at them. Mr. Pearl, did you have something you wanted to say?
No, I would agree. I think that everyone who should be potentially subject to examination by the Internal Revenue Service, you shouldn't be scared of the Internal Revenue Service if you're following the laws. I think the changes we're talking about in these proposals are really things meant not even for the 1%, barely for the 100th of 1%, for a few tens of thousands of the most wealthiest people in our country.
That may be what the
intention
intention is, but I got to tell you, people are just really, if you all are confused about what this is, imagine what Main Street businesses are confused about what all of this means. Now, talking about the audits, this July, GAO examined IRS audits of large partnerships and found that the agency is starting from a very weak position when they talk about bolstering these audits, much to the comments that you all have made. Between 2010 and 2018, 4 out of every 5 of those audits resulted in no change. And of those that changed, the company overpaid taxes and they were owed money back by the IRS. So I think that what we need to do is have some clarity around this. When you're talking about this new wave of audits and being focused on these complex partnerships, and then the GAO does the study, And that is not the problem where they found the problem to be. I think we need to be mindful of that. Mr. McBride, well, my time has expired. Mr. McBride, I'll submit a question to you on this issue for the record. Thank you, Mr. Chairman.
I thank my colleague, and I just want, because she has been a very, very constructive member of the committee, I want her to know I'm going to stay at it until we get the official definition of total positive income from the IRS. They know that I feel strongly about it, and we're going to.
Well, I appreciate that because people are so confused on this, and they keep saying, how does this affect me? And I'm in each of Tennessee's 95 counties every year, Mr. Chairman, and this is not a statutorial definition. This is a Biden administration definition, but there's not a working framework on this. And small businesses are trying to prepare for next year, and they're trying to make longer-term plans, and they're looking at business structures, and they have this undefined that this administration refuses. It's like Jell-O. They refuse to define it.
I think it is more like a sandwich that they have said is built around one principle, which is total positive income means that someone like a hedge fund manager can't wipe out their millions with capital losses. In other words, that's how they define it. But Senator Blackburn has asked about this at a number of hearings. I think we all have a right to have this in writing, and we're going to insist on it, and then we'll all share it at that time. All right, next up will be Senator Hassan is next.
Well, thanks, Mr. Chair, and to you and the ranking member for having this hearing. Thank you to our witnesses for being here. Mr. Pearl, this is a question for you. A large part of the tax gap, that is the difference between what people or businesses owe versus what's actually collected, comes from major corporations and multimillionaires avoiding taxes by underreporting their income, underpaying what they owe, or just not filing tax returns at all. Mr. Pearl, could you go over the recommendations you have for reducing the underreporting of income so that we can ensure that major corporations and the very wealthiest are paying their fair share?
Well, yes, we believe that the Internal Revenue Service needs the funding to hire lawyers and experts who can deal with these things. Most of what I've been talking about, Senator, is not really the people breaking the laws, but really the fact that the laws that we now have allow the wealthiest among us to pay far lower tax rates than your constituents who work for a living.
Right. And so just to follow up on that, when the tax laws allow major corporations or the highest earners in our economy to not pay taxes, what recommendations do you have for changing those laws?
Well, what we're suggesting, you know, along the lines of what the chairman proposed and the president, is changing the law so that economic income, whether it's income from wages or income from your stocks going up in the stock market, are all taxed the same way for the highest earners. And, you know, we don't even mean people who make $400,000 a year. Right. We mean people who make millions of dollars a year. Those people should pay taxes on the money they make that increases their wealth, regardless of what form that income takes.
Thank you. Ms. Wong, the IRS needs to continue to improve services for taxpayers, such as making it easier for them to call the IRS and quickly get answers to their questions. And I would expect that every single senator up here has a constituent service team who spends a lot of time talking with taxpayers who can't get hold of somebody at the IRS. But the IRS struggles to do that in part because of the need to devote significant resources to stopping tax avoidance by major corporations and the very wealthiest individuals. So how does underreporting of income by the ultra-wealthy divert resources away from improving taxpayer services at the IRS?
It absolutely does that. We shouldn't be focusing on the small amounts of money that many low and moderate income people They're just making errors on their tax returns. A person filling in a return for a child tax credit, for instance, faces a series of instructions that is as complex as someone who is high income in filling in the alternative minimum tax.
Well, thank you. And then this is just really a question to the full panel. We're here today talking about this tax gap, and you've all made suggestions, but I'll start with you, Dr. Holtz-Eakin. We'll go down. What's your top recommendation to help close the tax gap? You've all hinted or said different things, but let's just go down the line.
So just to be clear, the tax gap is evasion. It's illegal. And so that's an enforcement issue and comes down to having an effective audit strategy at the IRS and the resources to implement it. Most of what we're talking about today is avoidance, which is legal, and that means changing the tax code to reduce those opportunities.
Thank you. Dr. McBride.
I would highly recommend radical simplification of the tax code. As I mentioned, there are examples around the world to look to with much simpler tax systems, and they find a greater rate of compliance, voluntary compliance, and much lower administrative costs. And I'm particularly thinking of the country of Estonia, and you can find more information about that on our website.
All right, thank you. Mr. Pearl.
Yeah, thank you. I also emphasize, well, most of what we've been talking about is tax avoidance, which is legal.
Yeah.
But if you're concerned about compliance, well, sure, if you lower the tax rates to 0, you'll get 100% compliance. But I don't think that will actually solve the real problem we're trying to solve, which is fairness in our country and funding to fund the government.
Thank you. And Ms. Huang.
It's absolutely a line between avoidance and evasion. I think one of the things that is important to note is that a complex series of tax breaks push people into that grey area and then sometimes over the line. So we both need to look at resources for enforcement, but also the tax breaks that sort of feed this planning activity.
All right. Thank you very much. Thank you, Mr. Chair.
I believe Senator Warner is next.
Thank you, Mr. Chairman. I appreciate you holding this hearing, and I know this is an issue that you and a lot of our colleagues are passionate about, and I want to work with you and others to get this a solution that works. I also want to echo what I think a number of my colleagues have said about IRS enforceability. The easiest way we can start down this path is to make sure the IRS gets back to its capabilities it had, for example, under President Bush, which means it's going to need some of these resources. I've been thinking a lot about this, and it's a hard thing to kind of come to a conclusion on. I think we got to. I appreciate the comments from the panel. If we're going to do this, it's got to be fair, it's got to be simple, it's got to be comprehensive. We got to find a way to make sure that folks don't game the system. As somebody who was lucky enough to be an entrepreneur myself, and then as a venture guy funding a lot of entrepreneurs, I think we need to make sure we don't stamp out that growth piece of our economy. And I appreciate, Mr. Chairman, that you've actually got the buy, borrow, and die platform up there, because that's where I want to dig in, and I think Mr. Pearl actually made reference to that. I want to focus on the borrow piece, because one of the things I still struggle with is some of the proposals that put a tax in place without a realization event. And I can't find other examples of that in other nation states. But I do think the nature of our tax codes, that you can borrow against your assets, oftentimes liquid stock assets that some of the best billionaires around do that on a regular basis, and then they ultimately die and they pass on those assets without any realization event, yet they have used the system to fund their lavish lifestyles. And I guess I'll start, Ms. Wong, maybe go down the panel, but this notion of, particularly if you're borrowing for lifestyle as opposed to borrowing to make an additional acquisition, I think is an area that has some difference. And I do think there's been some recent testimony that has indicated that there might be a lot more with the appropriate use of borrowing as a realization event with assets of certain size might obtain a lot more tax revenue than previously thought. So, Ms. Wong, then we'll go down the list.
Yeah, so I think you're just sort of putting your finger on the fact that billionaires can spend their untaxed capital gains income, and that's most obvious when they're borrowing against it and they're purchasing things with it. It really just sort of puts a finger on the point that this is income in the real world. It's not just some theory that us lawyers and economists have dreamed up, but they're real world resources that can be used, and it's just the tax system that's currently ignoring that resource. And you're correct that there are lots of options for addressing this. Some of them include taxing those gains closer to when they're made. Some of them focus on that sort of consumption out of that wealth. And I think they deserve serious study. What isn't sound is just a system where that income can evaporate out of the tax code altogether.
Which is obviously the case, and we can all list lots of people who use that tool. Mr. Pearl?
Yeah, I agree with what Ms. Wong said. Essentially, if I'm able to borrow money against my brokerage account, as long as the stocks that I own increase in value at a higher rate than the interest on the account, I'm still becoming wealthy over time. The broker's perfectly happy to see a debit balance increase indefinitely for my entire life. And it's essentially economically the same as a realization event, except it's not taxable. And yeah, so I agree with you.
Dr. McBride?
I would point out in these scenarios that are being described here that we're talking about corporate stock, I think, is the primary example, and that's because that is, you look at the wealthiest individuals in the country by whatever, publication is doing that analysis, they do tend to be entrepreneurs that have built a business that is subject to, you got it, the corporate tax. So I think it's what's missing in these discussions is that even if the individual is not, that holds shares in these companies, and we're talking about founders typically that have a lot of shares, that if they don't realize by selling the stock in any given year, that doesn't mean they pay no tax, because every year the company that they own is subject to corporate tax, 21% on income.
Yeah, but the actual tax, as you know, Dr. Bride, is functionally much, much lower than that. I probably should have gone the opposite way on this, but Dr. Holtz-Eaton, I know my time is up, but please.
Well, I mean, the key, as you mentioned, is to maintain these incentives for growth. And so we've had in the code full expensing of investments, capital investments, investments in technologies and business models. And that's a fantastic growth incentive. It's very important to have. It also changes the effective tax rate on the normal rate of return to zero, which I think is fine. I'm a zero tax on capital guy. If you allow them to borrow and make that investment, the effective tax rate's negative. No. So you give them the growth incentive. Don't also allow them to do the interest deductibility. Get the effective tax rate down as low as possible and get rid of these avoidance opportunities.
Thank you. Thank you, Mr. Chairman.
Welcome. I think I had a chance to say hello to each of you before the hearing started. And I've missed up a good part of it, but I'm here now. I'm happy to see all of you. Thank you for spending this time with us. I used to be state treasurer, elected treasurer when I was 29 years old. Nobody else wanted to run. We had the worst credit rating in the country. Elected a governor, a Republican named Pete DuPont. He turned out to be a great governor, a good mentor for me. And he, in spite of having large deficits, he led an effort to reduce our personal income tax. Led our effort, and we did. When I was governor, I think for maybe my last 5 years as governor, we trimmed it back, I think, 5 times, 5 different years. So we ended up with, instead of having a 19, almost 20% marginal personal income tax rate when he stepped down as governor, it was probably closer to 6 or 7. And we always balanced our budget, always balanced our budget. And we ended up with, when I was governor, AAA credit ratings. We still have AAA credit ratings. So the question is, can we go out and collect taxes that are needed and that are to fund programs? Yes. We've shown we can do that in Delaware, and we make sure that people pay their fair share of taxes. I remember I used to hold, and I know my colleagues who served in the House with me, including the chairman, but I used to hold a ton of town hall meetings. Once a year, I do a town hall meeting in each county, and we would invite the IRS to come. We'd invite the State Division of Revenue to come. We'd actually provide services on site on a Saturday to dozens, scores of people who would bring their taxes and say, I need some help in filling out. My last year as governor, the Delaware's Quality Award was awarded. It was awarded to the Delaware Division of Revenue, the Delaware Division of Revenue. And because they provided great service. Great service. People had an issue, they could call. Or they could come to a town hall meeting. And they had offices in all 3 counties. We only have 3 counties where people could get the help that they need. And I remember having in one of my town hall meetings we will actually do an exercise where we'd invite constituents to come and balance the budget. Balance the budget. And, it could be, you have to, spending, entitlement spending, discretionary spending. And I remember this one time we were doing this exercise, having a hard time balancing the budget with the group. I just kind of let them lead it, and I just shepherded a little bit. But they couldn't balance the budget. And I said to them, I said, revenues is a piece of the pie, and that's an option. And it's one I'll never forget. This one lady in the back of the room raised her hand, and she said, I don't mind paying my fair share of taxes. I just want to make sure other people are as well. I've never forgotten those words. Never forgotten those words. And I've sat here on this committee for almost 20 years, and I can't tell you how many times we have our IRS commissioners come before us and said, in terms of things that they thought they needed for support from us, for technology, for people, the clarification of tax codes and so forth. But I think it's been a consistent message. But a big part of it is we need at the IRS, we need not just great leadership. I think we have that with Danny Werfel. We need the resources, human technology, in order to do a job. And we need to be able to provide service. When people have questions, to provide service, they call us and they get an answer, and they get the straight answer. We get a lot of calls in my offices in Delaware from people who need help, and we help them. We help them. So with that having been said, I have a question, a question or two here, if I can find it. So bear with me for just a minute. There we go. All right. Thank you for your patience. All right. First question. And this IRS funding strengthens nation's fiscal health. So, question. This is, and I want to make sure I don't mispronounce your name. Is it Hu Wang?
Huang, thank you.
Oh, good, thanks. How does funding the IRS bolster the fiscal health of our nation? I think I've sort of set that up. But how would the proposed repeal of these investments impact taxpayer compliance?
So the services that you were talking about are actually one way. People think about compliance and enforcement as sometimes a scary thing, but sometimes it's as simple as having the IRS be able to answer a question for someone who wants to do their taxes well and would make an error if they couldn't get a straight answer to what they need to be doing. So that's part of it. That's the reopening of the in-person taxpayer assistance centres across the country. The other part is going after more pernicious forms of evasion and avoidance, and that requires highly skilled auditors who can pick through the returns of the wealthiest filers, who are often complex. And that all brings in far more per dollar spent than is actually devoted to those people.
All right, thank you. Mr. Chairman, could I have another minute?
We're trying to get through.
I'll just stick around. I'll just stick around if I can.
Oh, great, terrific.
Thank you.
Senator Cassidy would be next.
Hey, thank you.
Depending on who else comes, but the order would be Senator Cassidy, Senator Casey, Senator Whitehouse. Senator Cassidy.
Hey, thank you all for being here. And I've been puzzling about this for a long time. So George Soros got a CARES Act check, meaning that he was earning less than $150,000. Now, to his credit, he gave it back. But the fact is that his income tax was that he was only making $150,000, and this is George Soros. Now, there's other examples, but I pick him because he's so well known. Would he be considered, Mr. McBride, among the top 0.001% that year in terms of paying income tax? Or because his declared income was so low, he was actually not considered part of that top 5%, 1%.
Well, I don't know his exact situation, of course, but I could guess that we're talking 2020, perhaps 2021, both years in which the stock market would have been
But my point is, if somebody borrows against their assets and doesn't take salary,
right,
and so their reported income is low, are they considered top among this top 0.01%, even if they're worth billions of dollars because they're Are we judging that percent by their wealth or by their reported income that year?
Generally by the reported income. Others try to supplement that with other
I'm out of
measures.
time. I got limited time, so I didn't know that. So, Mr. Pearl, I got a friend of mine who's always busting my chops on different things. He's a realtor, a real estate developer, and he says because of Section 1301, which I understand the importance of incentivizing people to turn that money over and the economic activity that it therefore generates. But he says, one of the things he busts my chops on, he says that he's made a lot of money every year for several decades, and he has not paid income tax for several decades. So when I read the statistics that the top percent are paying a disproportionate amount of the income tax, which I accept, it seems to me that must be a heterogeneous group, though. There are some who are really paying a lot, and some who are making a lot of money and paying nothing. Is that a fair assessment?
Well, yes, part of the problem, I think you're talking about like-kind exchanges.
Yes.
And yeah, part of the issue is that some people, if you're really rich, you don't need any taxable income, either because you borrow against your assets for buy, borrow, and die schemes, or because you have like-kind exchanges and a few other things that can reduce your taxable income.
So Ms. Wong, if I may, because you seem to be nodding your head kind of as we're tracking. So although some people who are billionaires are paying millions of dollars of taxes, there are others who are millionaires, like my friend, who's kind of like complaining he's not paying taxes. And I said, well, you could give the taxes if you wanted to, but he says that's not the point. So within that, there are those who, although making a lot of money, either because they're borrowing or they're doing like-kind exchange, et cetera, they're paying nothing.
That's exactly right, yes. And the problem is that when the statistics try to figure out who's in the top 1%, those people don't even show up in the top 1% because the statistics are based on what shows up on tax
Now, to be
returns.
clear, this is not their fault. That's the fault of Congress.
Absolutely. They're
Congress
just
has made
following
these laws, and so we've met the enemy, and he is us. I'd like to say they're the Democrats, but that's another issue. They would say me, that's beside the point. Mr. Holtz-Eakin, Dr. Holtz-Eakin, nice to see you, man. I couldn't quite hear what you were saying to Warner, but at the end you said something along the lines that we shouldn't allow people to borrow money and then to
Expense the investments they use that borrowing to purchase.
Say that one more. I'm a gastroenterologist, not an economist.
And so you've got your gastroenterology business, and you need to buy new equipment for it. So the tax code, until recently, allowed you to fully deduct, and there you buy that equipment, the cost of the equipment. That's exactly the right thing to do from my perspective. It gives you full cost recovery for your investment. You get it all back right away, and it provides excellent investment incentives. Now, that's essentially a zero effective tax rate on the return to that investment, and I'm fine with that. If we then give you an extra deduction for the borrowing, you change that zero to a negative number. We are subsidizing that business. I see no reason to do that.
And current law allows the deduction of that borrowing.
Yes.
Now, reading your testimony, I wasn't quite clear. Would you repeal capital gains tax and treat all income as ordinary income? Because you said to go to zero on capital gains. So does that mean that there's no taxation on the individual from the sale of a stock, even if it's escalated in value?
The easiest way to think about it is think of IRAs. Take your pick. You can do a traditional IRA, give them the deduction up front, but treat everything that comes out and tax it at the same rate. That would tax interest, dividends, capital gains all at the same rate. Or do a Roth IRA and don't allow a deduction, but don't even attempt to go after the capital gains. Take your pick. Both are good tax systems, very simple, good investment incentives.
You're implying that we're taking the worst of both as opposed to one or the other, which would be the best of one.
Let me stop implying and say, yes, we're doing the worst.
We're doing the worst. Okay, if you could send that to me offline, I'd appreciate that detail. Thank you all, and I had a lot more questions, but I'm out of time, but I really appreciate the testimony.
I thank my colleague. Look forward to working with him on these issues. Senator Casey, you are next.
Mr. Chairman, thanks for calling this hearing. I want to thank our witnesses. I want to start with kind of where we've been over the course of 40 years. Due to the rigging of the tax code over roughly the last 40 years, our tax system over and over again intentionally favors those with very large incomes and often very large lobbying organizations, while the middle class continues to suffer from very limited, if any, tax relief. Just by way of example, between 2020 and 22, just those years, corporate profits rose 75%, five times as fast as inflation. I released a report this week called Greedflation, meaning major corporations taking advantage of customers by jacking up prices and blaming it on inflation or using inflation as the cover to jack up prices. The report shows that the average middle-class family in Pennsylvania was forced to pay an extra $3,200 in 21 and more than $3,500 in 2022 just because of this greedflation. One corporate executive claimed that his company, quote, earned the right, unquote, to raise prices. Another executive at a different company bragged that their products are, quote, worth paying a little more for, unquote, just seemingly oblivious to what real people are paying at the grocery store and otherwise. These same companies and their shareholders were given what I would argue were obscene tax breaks in 2017 through the bill, and so now they pay much less in taxes on the profits as they squeeze out of American families. So, Ms. Wong, what's the best way for Congress to ensure that businesses' high profits are being appropriately taxed so that we could redirect or reinvest those dollars into the middle class and put money back in the pockets of those families?
Yeah, so I've heard my colleagues here say that there's a problem with potential double taxation of both corporate income and at the individual level. But if you look at the data, the actual bigger problem is double non-taxation. Corporate profits not going taxed, and then the gains also not going taxed at the individual level. And as you say, the research shows that a large and growing share of those profits, at the very low end, estimates are about 60% of those profits, are from windfall rents, monopoly power, pure luck, those sorts of profits that are not sensitive to tax rates or to new investment. So it's really important to make sure that that income at both levels is subject to tax and subject to tax once.
Let me just conclude with one more question. Chairman Wyden recently discovered something troubling about millionaires in this country. Not only do we have a problem when wealthy taxpayers pay too little in taxes, sometimes they don't even bother to file a tax return at all. From 2017 to 2020, there were almost 1,000 Americans with incomes over $1 million who did not file their taxes at all. They didn't file anything. These taxpayers owed over $34 billion in tax penalties and interest as of May of 2023. If we collected those taxes, we could give $450 on average to every child in America. Mr. Pearl and Ms. Wong, could you talk about how we can make sure that this small group of less than 1,000 millionaires pays their fair share in taxes?
Well, yeah. I mean, we think the government, whether it's Department of the Treasury and the IRS or the Justice Department, needs to have the resources to enforce the laws and make sure that these 1,000 people out of the hundreds of millions in our country obey the laws, just like all of your constituents who have tax deduction from their paycheck every week. Yeah.
Mr. Chairman, thanks very much.
Colleagues, and I'll also say to those who are following this, Senator Casey is a very modest fella. And what he was talking about, again, was trying to ensure that there was fair taxation and smart enforcement of the tax laws, because there's a lot of important things that America needs to do to get ahead. And Senator Casey has led the effort now for years on end to try to build a savings ethic in this country for young people. And I see all your heads, nodding, and we got the political spectrum kind of down there. If I had my way, what we'd have in this country, and I think we've got a chance to get started on it. I think we know that it's going to take a substantial amount of money, but if we cap some of these jumbo IRAs beyond the vision of Bill Roth and collect the money from the millionaires who aren't even filing returns, we could get started. And I'd personally like to see poor kids and poor families, when a child is born, go home with a little bit of a savings account, the kind of thing Senator Casey's been working for, to get them started. And it doesn't have to be some big government program. It can be some of the approaches Senator Casey's talking about. So I want to thank the senator for all his good work. And, you know, they're all talking about whatever that retirement name was, Secure 2.0, and we're going to have Secure 3.0, Secure 12.0, and all that. We may have good ideas for the future. Senator Casey's idea to help those kids with a small savings account. I want everybody to know, as long as I'm chairman of this committee, Senator Casey's idea is going to be at the top of the list, and I thank my colleague. Senator Whitehouse.
Thank you, Chairman, and thanks everybody for being here. I just want to flag for this committee that we had a hearing on this subject this week in the Senate Budget Committee, where we looked at the tax gap and learned first that the tax gap is known to undercount the actual tax gap because there are areas of omitted enforcement that it doesn't even look at. So it's a way bigger number than we think it is. The second thing that we developed in our testimony was that if you look at the top 10% of filers, the amount that the IRS obtains in revenue for a dollar spent in enforcement is $12. So it's a good deal more than we've been talking about looking across the board. And because President Biden has promised to focus enforcement on entities and individuals over $400,000 per year, we're starting to move closer to that 12-to-1 return on enforcement compared to what we've been talking about. Interestingly, it gets even worse the higher you go up the income level. When you get to the 0.1% of wealth, the return on the enforcement dollar can go as high as $35. $35 in revenue for every $1 in enforcement, which signals that there is massive tax dodging and tax cheating going on at the 0.1% number. So not only do Americans face a rigged tax code, they face the double whammy of rigged tax enforcement, even under that rigged tax code. So we have a lot of work to do. Two of the ideas I like, Mr. Pearl, billionaire Warren Buffett famously highlighted the rigging of the tax code by pointing out that he paid lower tax rates than his secretary. My Pay a Fair Share Act would codify what is called the Buffett rule, with a minimum 30% tax rate on income over $1 million per year that phases into the $2 million, so there's not an abrupt cliff. Can you say, how would this legislation make our tax system fairer? And from your experience on the investment side, would it cripple the private equity system?
Well, yeah, first, I was honored to stand with the president, then President Obama, when he made that speech about the Buffett rule. But yes, we think that needs to be fair. It's exactly the problems that Chairman Wyden was outlining about buy, borrow, die that results in Warren Buffett paying a far lower tax rate than his assistant does. And yeah,
and does it cripple the private equity system?
And no, we don't have a shortage of people who are willing to become private equity fund managers. There are tons of people applying for those jobs. As I said in my testimony earlier, I think if we're going to try to use the tax system to incentivize people to join certain careers, I'm sure that you can find several careers that are more in need of people than private equity fund managers are.
Thank you. Ms. Wong, let me ask you a question about another piece of legislation of mine, the Medicare Social Security Fair Share Act. You were kind enough to come to the Budget Committee a little while ago and testify about that. That bill has a provision to support Social Security and Medicare by closing the so-called Gingrich-Edwards loophole that lets wealthy individuals avoid Medicare taxes. Would you mind walking the committee through how this loophole works and through how much revenue closing it might raise to support Medicare?
Yeah, so the loophole is that some wealthy filers can funnel their income through an S corporation. And if they do so and they underpay themselves salaries and put more of that return into business income, they can avoid both facing any of the Medicare taxes on payroll, on self-employment income, and on investment income. So they fall right into the gap. And some
the
of
money
that,
ends up in their pocket either way. It's just a question of which way you route the money that you control into your own pocket.
It's hundreds of billions of dollars are going through there, and some of it invites people to even overstep into evasion. Speaking of fund owners, some fund owners right now are in disputes with the IRS because the IRS says that they've gone over the line by trying to push so much of their income into this hole.
The last thing I'd mention, Mr. Chairman, is that the other part of the hearing was on the improvement in IRS performance as a result of our funding of the IRS, and that there has been massive improvement in how regular taxpayers are treated. And we had a wonderful statement by Senator Romney saying, you know, if I'm a regular taxpayer, I'm going to call up, and it's going to really matter to me to be able to get that phone answered in what is now a 3-minute wait time. And that is really important for the service of regular taxpayers. But he said, once I became very wealthy, I wasn't calling up that service line any longer. I have accountants and lawyers who intermediate. And for that, you really need to have proper audit and enforcement. So I want to commend Senator Romney's statement to this committee. And with that, I yield back.
Thank my colleague. It's been good to work with you on all these issues, both here and at the Budget Committee. Senator Carper.
Thanks so much for letting me have a second round. Another follow-up, if I could, Ms. Wang. Do you believe that the role of non-compliant sole proprietors demands more attention from the IRS, particularly when it comes to wealthy taxpayers? And if so, do you have any recommendations for how the IRS should address this?
Yes, it absolutely does. And in fact, it's received so little attention because of the lack of resources of the IRS to understand what's going on that we don't have a great idea of what's going on with high-income tax avoidance using sole proprietorships. But pass-throughs overall, we know, are a really big source of tax avoidance and evasion. And part of the reason is, just like with sole proprietorships, a lot of the income that flows through them, it's really just on the honor system. The IRS doesn't have anything that they can check what the taxpayer says in terms of the source or the amount of income, and compliance rates on that income is less than 50% compared to 99% for W-2 wage and salary income.
All right. More broadly speaking, what steps should this committee and the IRS, for that matter, take to improve the tax compliance of pass-through entities? Does the IRS need additional tools or resources from Congress to support their work in identifying non-compliant wealthy taxpayers?
I think the oversight role that this committee has played in focusing the IRS's attention on partnerships and pass-throughs is really important. But additional tools that lawmakers could give the IRS is, again, the ability to sort of understand who owns what income when it flows through these spider webs of different types of entities. And that could include strengthening the Bipartisan Corporate Transparency Act and allow the IRS to be able to trace who actually owns what. And that's a really basic question that you need to have tax compliance.
Thank you, ma'am. And I don't mean to pick on you, but I do have another question. I'll let these guys catch their breath. But can you share with us how unequal audit enforcement has historically contributed to wealth and racial inequality?
Yeah, well, as audit rates on wealthy filers has plummeted, audits on low and moderate income filers has increased as a share of all filers. And in addition to that, we now know that due to research that the IRS itself put forward, black filers are 2.9 to 4.7 times more likely to be audited by the IRS, even at the same income level. And part of that has come about because there has been an over-focus on forms of non-compliance from refundable credits, even though they contribute a much, much smaller part of the tax gap than non-compliance by wealthy filers.
I'm going to have to move on. Senator
Yeah,
Carper,
thanks
we've
so
got
so
all
much
this.
for giving me the time.
Thank
And thank
you
you all for being here today and
Thank-
for your good
Thank you
good
for
work.
your good points. Senator Cardin.
Well, Mr. Chairman, I came back first to thank you for holding this hearing. I apologize, I've been busy on Senate Foreign Relations business, but I just really wanted to underscore the importance of the embarrassment in our tax code on the rate of compliance for high-income people and the amount of resources that are put in to audit lower-income taxpayers who in many cases do not have the same degree of help and services to allow them to understand our tax code, which is rather complex. We find that in so many different areas. I chaired a small business committee and found that small business owners, in trying to comply with the requirements we have, don't have the same resources as larger companies. This is a systemic challenge we have in our society. So my question is, we're giving the IRS a great deal of resources. How can we help middle-income taxpayers, lower-income taxpayers, with the type of information, outreach, and services that can make it easier for them to comply with our tax code so that the resources of IRS can be really focused on those that are not paying their fair share of higher income. Ms. Wong, you want to start? I see you're shaking your head the right way, so I'll start with you.
Look, you're absolutely right. Low and moderate income filers don't have expensive tax advisors, and they count on lawmakers to provide the IRS the resources so that it can answer the phone in 3 minutes instead of 28 minutes, or to have a taxpayer assistance centre right there in their community where they can go and talk to a real person. And they also count on the IRS, and this comes under the compliance bucket, to put out clear guidance about what their taxes mean. So that's really important.
Well, thank you. Mr. Chairman, I would hope that we will put a concentration on how we can help middle and lower income families get the information they need so that they can get the benefits they're entitled to, because in many cases, they're losing out on benefits that they're entitled to, and there's no one there to audit their returns to say you need more money, you should have gotten more. It's always that you made a mistake and therefore we're going after you. And I think with the resources given the IRS, as we go after the higher income taxpayers who are not paying their fair share, we need to devote resources to modest income families to make sure they're being treated fairly in our tax code. I thank the chairman.
Thank my colleague. We also ought to pass the Cardin Tax Preparer Bill in order to beef up work that's done in that area. So I look forward to working with my colleague, Senator Warren from Massachusetts.
Thank you, Mr. Chairman. So in 2017, the Republicans in Congress passed one of the biggest tax giveaways to millionaires and giant corporations in recent memory. The Trump tax cuts kicked working families to the curb while it added about $2 trillion to the national debt. Also, that Republicans could give a massive handout to their wealthy pals and donors. But the $2 trillion price tag on this doesn't actually tell the full story. That's because some of the corporate tax breaks had expiration dates. Now, expiration dates not because they actually wanted those tax breaks to expire, but expiration dates because that meant they could represent that the total cost of the giveaways would look smaller than they really were. Corporate lobbyists went along with this because they knew that when the tax breaks expired, Congress could be counted on to renew them endlessly. Now, 3 of the biggest giveaways are starting to expire, and the corporate lobbyists around here working overtime to get them extended. Ms. Wong, corporate lobbyists claim that these 3 giant giveaways, known as bonus depreciation, R&D expensing, and the net interest deduction, were really important because they would spur American investment. So now we have some data on how these corporate tax giveaways work. Does the data show that companies have used their tax breaks to make new investments?
So the corporate tax cuts in 2017 were even bigger than what companies asked for. And what we saw is trillions going into buybacks and dividends. Economy-wide investment in jobs didn't grow any faster than they had before the law. And careful economic analysis has failed to find anything near what was promised. And now, as you're saying, there's talk about adding to that retroactive business tax breaks, which would be just a complete wasteful giveaway. You can't change past investments or wages by giving away tax cuts like that.
So take bonus depreciation as an example here. Under normal tax rules, businesses are allowed to deduct expenses from their income so they aren't taxed for the losses that they take. Because certain assets lose value over time, like machines or buildings, businesses can typically deduct the cost of that depreciation over the life of the asset. But bonus depreciation takes this logic and turns it upside down. Instead of taking a chunk of the depreciation each year that the asset has value, say a new set of delivery trucks, bonus depreciation lets businesses deduct the entire cost of those delivery trucks in the year that they buy them. Ms. Wong, why do businesses benefit so much from bonus deductions, bonus depreciation?
So like a lot of business tax breaks, a company needs to actually be pretty big and highly profitable to take full advantage of it. You hear a lot of rhetoric about small and startup businesses, but they often can't actually even access these provisions because they don't have enough profits to offset them against. And the research shows that the biggest companies that are getting the bulk of the tax break are the least likely to actually increase investment or wages.
Okay, so the tax breaks are not used to increase investment, and in fact, these tax breaks, business tax breaks, are going to the very richest corporations. And now, like they did in 2017 and like they've done so many times before, corporate lobbyists are asking for a temporary extension of these tax breaks to make them look cheaper than they actually are. But they have every intention of pushing Congress to extend these tax cuts again and again and again so their wealthy clients will never actually have to pay the bill. Ms. Wong, if we look at the true cost of extending these three corporate giveaways that's being championed by lobbyists and not made-up versions that are being peddled by the corporate lobbyists, what would those figures look like?
Yeah, the sticker price here is quite misleading because the true cost is much larger. The official cost of temporary full expensing would be $3 billion through 2025. But if you were to make it permanent, it would be $325 billion.
Whoa, the difference between $3 billion and say that second number again?
325.
325. So the nominal cost of this, the representative cost of this, is about 1% of what you say it would really cost.
Yeah.
You know, look, I get it. Extending corporate tax breaks is really good for massive corporations, but it's also really bad for the American people. We should not be rubber stamping Trump tax cuts for giant businesses. While Republicans play political games, Democrats should be doing everything in our power to make sure that millionaires, billionaires, and giant corporations are paying their fair share. Thank you, Mr. Chairman.
I thank my colleague, and I thank our panelists. We've been at it for a couple hours here, and I'd like to just wrap up this way. You know, when I'm home, you know, people say, are we going to have one of these town hall meetings, Ron? Are we going to have another one of these? We like them. We just kind of can come and say our piece. And I've had like 1,065 of them. We have 36 counties, been all of them. Again and again and again, 90 minutes, throw open the doors, and no subjects are off limits. And the percentage of time devoted to taxes is high, and it continues to get higher. And it goes something like this. People say, Ron, what is the deal with the tax deal? Because it is so hard to understand, and it sure looks like it just favors a small number of people who can work the system. And I say, well, let me offer you a couple of thoughts that I think at least give you an idea how I see it. So you ask about the tax deal, and I always say there are really two tax deals in America. One is for the people who are the firefighters and the nurses, and they pay taxes with every single paycheck. And that really colors everything they do. For example, even if they're going to be audited, the government already has a lot of their information because they pay taxes with every paycheck. Then there is another system, which is illustrated by the sign up here, that if you're a billionaire, and Ms. Wong told us how it was done, you bring in your accountants and you bring in your lawyers, and you say, I don't want to pay any income taxes this year. Make it possible for me to buy. And I gave examples of that, and borrow. And then when you die, everybody starts all over again. And Bill Bradley was on the Finance Committee for a number of years. I worked with him. I was a junior member of the House. Doug Holtz-Aiken is smiling. He remembers Bill Bradley. And he was another tall member of the Finance Committee, but he had a better jump shot than I did. And we always talked about, what do you want in a tax system? And he would say, Ron, we want a tax system that gives everybody in America the chance to get ahead. And that's what I want to close with. Because to get a tax system that gives everybody in America the chance to get ahead means it's got to be built on the idea of being fair to everybody and a system that is going to give everyone a chance to be successful. Because that's what America is all about. That's America at its best. So we appreciate the input that the four of you have given us. I'm putting the final details on our proposal that we have been working on for some time to lay out how we go about fixing this problem of billionaires avoiding taxes through buy, borrow, and die, and giving everybody the chance to get ahead. So we'll look forward to staying in touch with you. Our doors will always be open to you four. We've worked with you in the past. It's been a very good hearing, a busy week for the Finance Committee. Yesterday, we passed a major piece of health legislation to rein in these PBM middlemen. Passed it by the narrow vote of 26-0. My wife asked me about it. I said, you can't get 26 senators to order a 7-Up right now without a big controversy. So the Finance Committee is serious about these policy issues, and you saw it again today, where you didn't see a lot of shouting and hollering. You saw people who are serious about dealing with making the tax system smarter, better, fairer, and one in which we can all enjoy substantial success. So I want to thank our guests, and with that, the Finance Committee is adjourned.